would you characterize this walk back, fairly rare, coming on the heels of Williams' comments?
It is, as you said, it is very rare. I think it tells us that the Fed is, trying to reassure markets maybe that things are not as bad as a 50 basis point cut in July would suggest. And maybe a 25 basis point cut is more likely. From here, the market is really focusing on what the Fed is going to do, of course, in July, but what it indicates it will do in future. So what is it going to be signaling? And I think from here at this point in time, it's the earnings seasons that the Fed is going to be watching closest.
And does this change at all what you expect, what the prospect is for a rate cut from the European Central Bank?
Well, it's interesting, actually. With Europe, they are in a slightly different situation to the US, whereas for the US, we have got a clear indication maybe that I think that maybe economic indicators could be turning, and certainly we think that by the end of the year, we will see a bit of a turnaround in the US economy. By contrast, for Europe, their outlook is a lot weaker. They have been suffering from below target inflation for a long period. So if anything that happens, it seems that most likely that the ECB will be doing some kind of action in September, and we'd expect that next week at the ECB meeting, they will take the time to really prepare markets for any kind of moves that they will make in September.
Lay out for me, if you will, how you seeing the second half of this year playing out, where the rate cuts come into play and where earnings come into play, and how that shakes out these next 6 months.
Right, so the way I consider it at the moment is I feel like risk assets are really at the crossroads. What we've seen this year with this very drastic move up in equities has actually been driven by multiples, not by earnings. And at some point, I feel that multiples need to be validated by stronger earnings. And that's why this earnings season is very important at this stage. On top of that, we also have the Fed to consider. Now, the Fed, if you look at the S&P moves over the last 6 or 7 months, most of the big moves have been on days where the Fed has spoken. So really, it's the Fed that's been driving those multiples too. So the sentiment is up. So if we see the Fed meeting market expectations, we should really expect risk assets to rally very strongly for the remainder of the year. By contrast, if you've got weak earnings and you've only got a 25 basis point cut by the Fed, then I think that we're going to see a much weaker move ahead for the second half of the year. So I think we're at a crucial time right now, which will guide us to where assets are going for the rest of the year.
Seema, we were just showing some of the big companies to report earnings next week. We're going to see a heavy focus here on companies with international exposure: Whirlpool, Boeing, Caterpillar, and the like, Amazon, Alphabet. Talk to me a little bit about how the prospective resolution on trade tensions plays into this, or whether we're going to see a continuation of this standoff with China.
So it's interesting you say this, because really with those larger companies, the focus is obviously going to be on guidance. And one of the reasons is, for economists, it's very difficult to measure what the actual impact of this trade war has been and will be. So there is a continued second round effect on sentiment, which will impact business intentions, investment, etc. And that's why there's going to be a lot of focus on those larger companies which do trade internationally, so there's big multinationals. From my perspective, maybe the market seems to have forgotten a little bit about the risks to do with the US-China trade war. It seems unlikely that there will be a full resolution anytime soon. So we could see repeated escalation, a couple of tweets here and there, which will upset markets. And I think that that's going to continue to weigh actually on multinational earnings guidance over the next few months.
And as we continue to talk about what's in store from the Fed coming up and central banks around the world, what are you expecting to see in terms of investors taking on risk?
Well, the one thing that we have seen is that so many people just didn't get in on the rally since the beginning of the year, and they are desperate to put their money to work. So as long as you don't see a serious economic slowdown, certainly we do not see an economic recession in the foreseeable future, it means that people are still willing to put their money to work. So as soon as you get some kind of dip, you're most likely to see investors rushing back into the market to buy up whatever assets there are. So you're looking to buy the dip, which is why any correction that we may see over the next few months, if it's triggered by earnings or a more hawkish Fed than the market is expecting, is likely to be only short-lived, because investors are really desperate to put their money to work.